He's Brian Belski, the chief investment strategist at Oppenheimer. Brian, good to see you. And, I'm looking at this 1,300 target, and I'm just wondering if you're expecting some kind of post-election leap or something like that.
Well, actually, we look back to find if we could see a precedent for this type of activity, especially coming out of a recession. And we really point investors toward 1976, coming out of the 73-74 recession, which we think is the most comparable one to what we've just encountered in terms of what we've seen with the consumer, commodities, and consternation in Washington. So 1976 was a very volatile year, and the returns were very, very fixed within a very short time period. Keep in mind, too, 1976 was an important election year. We also looked at other election years like 1994 and 2004, and we also saw very short-term blips that were very violent to the upside that really constituted the majority of the upside for the year. So we think the market can be very surprisingly positive. This is one of the most reactive periods in my 21-year career on Wall Street. No one's proactive, everyone's being reactive. And we really think what happened in May and June really set the table for everybody to become very defensive right now.
Brian, it's John Erlichman, and you're absolutely right. I just pulled up a long chart of the S&P and found, yes, at the end of 1976, you did see a move higher. But what about real reasons for people buying stocks? You know, we asked this same question to one of your peers, Tom Lee, recently. I mean, the S&P would have to climb more than 20% from its current levels to get to the target you're talking about. Earlier this year, we saw a big move, but it wasn't nearly as much as that. It was like 15%. So fundamentally, what is the one reason why people will buy stocks between now and the end of the year?
Well, we like to take a couple steps back and remind people that GDP is comprised of C plus I plus G. We think the strength going forward in our economy and our stock market's coming from the I part of that equation, meaning the industrial base of the United States. And that's really being defined by the great earnings that we've seen from companies. We're seeing real growth, real revenue growth, real margin expansion, and most importantly, real positive operating performance to the tune of rising return on equity and cash flow. And we think those are important things that many economists aren't looking at and many investors are not paying for because of this very reactive and defensive tone, the way that people are managing monies. Remember, we were one of the most bearish strategists on Wall Street in 2007 to 2008. A lot of people thought we were crazy. This year and last year, we were one of the most bullish strategists on Wall Street. People think the same thing. And this whole notion of what's going on with bonds is beginning to really scare us.